So you are ready to finally make that move and purchase your first home because you are either tired of living with your parents, you're tired of your roommates, you're tired of paying rent, or you are just simply ready because you are ready. Make sure that you grab your notepads and your pens because today I'm going to be sharing with you some really enlightful tips on how you can make your dream become a reality. Keep watching. Hello beautiful people, it's your girl Shy-Bivia and welcome back to my channel. If you have not done so just yet, make sure that you go ahead and hit that subscribe button and the notification bell as well. Without any further ado, in this video I'm going to be sharing with you about 12 steps as to how you can become a homeowner, whether in your 20s or beyond. Now let's get right into it. But first things first, I just want to say this, right? Yes, I am now married, but 2 years ago when I purchased my first home at 23 years old, I was very much single. Okay, so it is doable as a single person. You want to focus on building your credit. Now, not only does a good credit score give you an advantage in the approval process, but it also determines what your interest rate will be. And believe it or not, like, the difference of a percentage or two makes a huge difference of thousands of dollars over the life of the loan. Now, you know, we hear the term building your credit and all of this over and over, but what does it really mean to build your credit, and how is it that you can really build your credit? So here are just a few things that you can do to help you establish credit from early on. Now, you can first focus on taking out a very small department store card, maybe $300 or a $500 limit, or whatever you are approved for. Then what you are going to do is only spend what you can afford. So not because you get approved for a $600 credit limit or $300 or whatever, it does not mean that you should spend all of it and carry over balances. Focus on only the most that you want to do is carry over. The most worst case scenario is 30%. So you want to focus on a 30% utilization ratio. So for example, if you were approved for, let's say, a $100 limit card, the most that you want to carry over is $30. But what you want to do, okay, for best practice, is that you want to pay everything. So if you used $30 this month, by your next statement period, you want to pay that entire balance. And just think about it, it's a small balance anyway, so it shouldn't be that hard to pay off. And it is a good practice for the long run when you start taking out credit cards with higher limit. You don't want to put yourself in significant debt. So that's one of the ways that you can start building credit. Another way that you can start building credit is by, if you are currently renting, like renting an apartment or something, you do have the option of selecting if you want it to be reported on your credit report. Some leasing agencies, they do that. Usually with the credit bureau, you're able to have your rent reported on your credit report, you know, showing your on-time payments and all of that. All right, now another way that you can establish or help establish your credit is by being added as an authorized user on your parent's card. Now, you want to only do this if your parents are really responsible, you know, with their debt. They take care of their debt. They have a really good credit score, like, you know, maybe over 730, or, you know, 730 or over. Now, being added as an authorized user does not necessarily mean that you have to have access to your card. So if your parents aren't familiar with that, you can do your research a little bit more into that, but being added as an authorized user allows it to be reported on your credit report as well. So that's another really good and easy way to establish credit, but just make sure that it is you are added as an authorized user on a trustworthy person's account, okay? Maybe like your parents and aunt or somebody, but just not anybody, not some friend that you know that has a credit card or anything like that. Now for my folks that already have established credit, you want to just focus on lowering your debt as much as possible. So if you do have credit cards, focus on paying those off as much as possible. If you're not able to get them entirely down to zero, what you can do is focus on also paying it down to at least 30% utilization ratio. Okay, so that really helps to improve your credit as well. So the next step into your home buying process, step number 2, is to do your research. Now, what type of home are you hoping to purchase? Is it a multi-family unit? Is it a single unit? Is it a condo, a townhouse, row house? What type of house do you want to purchase and why? Some people like to purchase the multi-family unit for investment purposes, because then you're able to rent those out and you're having, you know, rental income coming in, and that's a really good buy. I won't get it much into that, but do your research as to what type of property do you want to purchase, and this makes it easier for you when you're doing your search. It makes it easy for you to filter and narrow your searches online, and eventually when you start working with a realtor, it makes the job much easier. Now, step number 3 is how much house can you afford? Now, the question shouldn't be how much can I borrow, but the most important consideration should be how much house can I afford? Now, online there are some really great calculators that you can use to determine how much house you're going to be able to afford based on your current debt, your income, and all of that. Now, most lenders, most mortgage companies usually borrow or lend, I should say rather, lend you up to 3 times your annual salary. It can be between 3 to 5 times. So you can kind of, based on your current salary right now, you can kind of, you know, do an estimate as to how much house you'll be able to afford. Now, most financial advisors will agree that you don't want to spend any more than 28% of your gross monthly income on housing expense. It's like it's called the 28-36% rule. I also wrote an article on this, how to purchase your first home in your 20s, which I will link below, and it does go a little bit more in depth with the 28-36% rule, which you can check out below, and also feel free to subscribe to that as well. Now, during this time that you want to focus on, you know, how much house you can afford and all of that, you can also see if you may be eligible for some type of grant. I will link it below as well. It's also in the article that I wrote. You can go to HUD.gov just to see if you're able to qualify for a first-time home buyer's grant. Okay, so now that you have improved and built your credit and did your research and all of that, now to step number 4. Step number 4 is you want to start saving for your down payment. Of course, you can't buy a house without a down payment, right? Unless you decide to go through NACA, which is a whole another process that takes about 6 months to a year, but you know, that is also an option. I will also link that below, okay? But you want to start saving for your home. Now, here's the thing. A lot of people, you know, always get hung up about the fact that, you know, this whole 20% deposit. Now, you do not necessarily need 20% to be put down as your down payment if you are doing an FHA loan, okay, and that's for first-time home buyers, or even if you decided to do a VA or a USDA loan, okay, you don't need 20%. The minimum needed is 3.5% of the selling price of the home. Now, the difference between putting down 20% and 3.5 is that if you aren't able to put down 20%, you will be subject to PMI insurance, and that is private mortgage insurance. And this usually adds a few dollars to your monthly mortgage payment. It can be anywhere, it all depends on the mortgage, so I can't really throw numbers out there, but it's usually not anything significant. It's usually not like hundreds or thousands of dollars. If you're looking at the average mortgage, it's usually can be anywhere between maybe $50 to $200 or $300, depending again on the actual overall mortgage. So that will be the difference of paying the 3.5% or paying 20%, as well as the obvious, the more you put down, the less your monthly mortgage payment will be, because you would have paid off, you would have put down a higher deposit. So those are the difference with putting down 3.5% or 20%. So now, one of the ways that you can start saving for a home is by opening up a separate savings account, okay? Now, this is not the savings account that is directly linked to your checking, that you have a card, linked to it where, you take it to the mall just in case. It's not one of those savings accounts I'm talking about. You want a savings account that's either solely online, or just a savings account that you don't necessarily have a card attached to it. And what you can do is you can set up automatic withdrawals or automatic transfers from your paycheck. So for example, every time you get paid, you have 10% of your paycheck going towards that savings account that does not have a card linked to it, okay? So that's a really good way of saving. Now, I do highly recommend having a credit union. It's always good to have a credit union account, even if you do decide to have a main bank, okay? It's good to have a credit union account, and you also have other banks out there that offers high interest rate on savings accounts. The average interest rate on a savings account, these days is like 0.05%, and that is not a lot. Not 0.5, not even 0.5%, but 0.05. And so try to find a credit union or a bank that offers a higher paying interest rate. So while you're saving, you're also building interest and you are growing your money. Let your money work for you, okay? Step number 5, get pre-qualified, okay? Now this time you get pre-qualified, pre-approved for your mortgage. Now getting pre-approved for your mortgage, this tells you the range of housing that you will be approved for, that you should, you can now start looking for. Now this saves you the disappointment of looking for homes that are way out of your price range, that you wouldn't be able to afford anyway. It also saves you and your realtor time, and we're gonna get into that. Now be prepared to start providing the lenders with your bank statements, W-2s, pay information, and all of that once you have decided what lender you want to go with. Now this is a quick tip. Now once you start applying for mortgages, the credit bureau, they give you 14 days to apply to as many mortgage companies as possible, because they do understand that buying a home, you do want to compare prices and mortgages and all of that, right? So you have 14 days to apply to as many lenders as possible, and it will only be reflected on your credit report as one inquiry. So if you applied to 10 different lenders within that 14-day period, it is not going to show up as 10 different inquiries, and it's not going to affect your credit score. It would only show up as one credit inquiry. Now here's a mistake that a lot of shoppers make that you should not make, because you have watched this video, or at least I hope, is that not because you get approved for a mortgage means that you should now go on a shopping spree, running up your credit cards and purchasing home stuff, or purchase a new car to go with the new home, or all of that. That is one of the biggest mistakes that you could make during the home buying process, because not because they already ran your credit doesn't mean that they won't run it again. Usually in the buying process, about 30 days or so out of closing, close to closing, or even closer, usually the day before closing or sometimes on closing, for whatever reason, they rerun your credit report. And if they see your debt increased, significantly or even slightly based on, how your approval was, if it was just, borderline, you can be then denied. And it's just the worst thing to go through the entire process and then close to closing get denied. So don't make that mistake and go on a shopping spree. Try to use your debit card mostly for the most part. If you do use your credit card, just pay the balance off, as you were doing before. Do not go on a shopping spree, and do not go applying for other loans. Now, step number 6 is to find the right realtor for you, okay? You don't want to work with just any realtor, okay? You want to work with a realtor that will be on their P's and Q's, okay? A realtor that will be open and honest and is just simply a hard worker, okay? And if you think that you are stuck with the first realtor, okay, do not treat the relationship as it is a marriage in the beginning. Treat it as if you guys are dating. See how compatible you guys are. See if the relationship will work. See if they're a realtor that you want to work with. Remember that you are the boss. One of the benefits of having a great realtor or having a realtor overall is that they provide information that is not usually available to the public. Now, having a realtor is at no cost to you, okay? The realtor gets paid at closing by the seller, and they get paid a commission by the seller. So having a realtor doesn't mean that you have to pay them up front. And now that you have found the right realtor for you, now you can start home shopping, okay? Now, this should be the fun part, but this can also be frustrating, okay? Because you'll find that you start looking at houses, and by the time you're ready to put an offer on the home, somebody else had put an offer on the home. Because think about it, the same reason you thought that the home was fantastic, that the home was great, is the same way another family thought the home was great as well. So during this process, yes, you want to take your time because you want to make sure that you are choosing the right home for you, or the right home for you and your family. But you also don't want to drag your feet, because some of these homes, I'm telling you, they go like this on the market, especially if it is a steal. So try not to drag your feet during this process. Now, be sure to take pictures, notes, videos, whatever it is needed to help you remember during your decision process. Also, make sure that you're checking to make sure that the electricity, plumbing, and all of that works. Do note that sometimes the seller may turn this off to preserve energy or for whatever other reasons. But for the most part, try to, check to make sure that, those things are working properly. Also, you want to make sure that you're evaluating the neighborhood. What is the traffic and noise level like in that area? Is it close to public transportation? Is it close to schools, parks, stuff like that? You want to make sure that it is a neighborhood that you see, fit for you, or see fit for you and your family. So step number 8 is the attorney review and inspection. Now, the seller and the buyer has a right to an attorney review. Not everyone uses an attorney, but it is definitely beneficial. This is where the attorney reviews the real estate contract to scan for any appropriate legal protection. Now, the attorney review takes 3 business days. They don't count holidays, weekends, or anything like that. Now, after the attorney review is done, then you have about 10 to 14 days to get your home inspection. The actual purchase of the home is contingent on the inspection, the outcomes of the inspection, and be prepared to pay out of pocket for this. This can range anything between $300 to $700 that you'd have to pay out of pocket. And this is where they check like the plumbing, electricity, all of that, and so forth, you know, heating system. Now both you and the seller will get a report of, you know, the fixtures and anything that needs to be repaired. Now this is where you will have the opportunity to renegotiate the price. You can either renegotiate or withdraw. So if the seller chooses, you know, not to fix something, you know, you can either withdraw your offer or say, hey, you know, I want to renegotiate and have the price lowered. Now, step number 9 is to select your mortgage with your mortgage banker. Now, there are, you know, different types of loan programs to choose from. So you want to choose the one that best suits your needs. You know, think about if you're looking at, you know, is lower payments more important to you, you know, having, you know, fixed payments more important to you, are you planning on moving within a short period of time? You know, think about your needs. You know, you have the ARM mortgage, short for the adjustable rate mortgage, where, you know, I also talk about that a little bit more in the article, you know, that I wrote, so you can check that out. But you know, the ARM mortgage is, you know, it fluctuates, so you know, think about if you want that type of loan or you want a fixed loan. Some buyers tend to go with the adjustable rate mortgage because they want a lower payment, you know, for the beginning of the loan term. But just remember that in a few years, you know, the payment may or will go up, so you just have to be prepared for that. Now, step number 10 is to have an appraisal done. Now, this is where the lenders arrange an appraisal to determine an independent estimate and value of the home. Now, this is usually done through a third-party company outside of the lender, and they will go out, you know, to determine the value of the home based on the size, the fixtures, all of that, new appliances, and all of that. Be prepared to pay out of pocket for this appraisal. It can range anywhere between $300 to $700. It really all depends. Guys, now we are getting close to closing. Okay, step number 11 is where the paperwork is now coordinated, and this is where the lender contacts the title company to just make sure that the seller is the rightful owner. During this time, you may also get disclosures to sign, and the disclosures is not the final closing document. This is just like an estimate of like the loan terms, the points, fees, and all of that associated with your mortgage. And this is usually well, nowadays done electronically. It makes the process a bit smoother and faster. You just want to make sure that you're doing your part and you're reading the disclosures carefully and make sure that everything is accurate. Okay, so finally, y'all, we made it to closing. Now it's time to close on your new home after all the paperwork, the phone calls, all of that, the anxiety possibly. We made it to closing. Okay, now at closing, it should be yourself, your realtor, the escrow or closing agent, the seller or the seller's realtor, your attorney if you had one, the lender should all be at closing. Now at closing, you'll be required to bring the final closing amount in the form of a check. Sometimes you may get a refund if you had an overpayment. After you close on your documents, you should have your new set of keys, and now you are a brand new home owner. Let me know if this video was helpful. Let me know in the comment below if you plan on purchasing a home, if you already have done that, you know, what your process has been like. I'm wishing you guys all the best with your home buying process. Okay, again, it's your girl Shy-Bivia. It was an absolute pleasure. But before you leave, don't forget to hit that subscribe button and the notification bell as well, and give this video a thumbs up if you liked the video. Okay, so thanks for watching again, and I will see you guys later.